Khiem Do, head of Asian multi-asset bearing asset management, joins us live from Hong Kong. Khiem, good morning and thank you for joining us. Khiem, for the moment, both emerging markets and developed markets are in a sweet spot. Do you think good days are here to stay, or for the moment this is as good as it gets?
We think that there's a very good positive momentum in favor of China, of India and the rest of Asia and emerging markets relative to developed markets. And I think that that's basically because China has finally decided to loosen up a little bit in terms of its monetary and fiscal policies, and that helps to restore and strengthen the sentiment of investors towards this asset class.
Khiem, if I look at the emerging market performers, Indian markets clearly are right on top of the heap. India is the market of choice for most of the global investors. Do you think it could remain like this for another year or so?
I think that the positive perception about India reforms is very strong. However, I do think that India has to deliver those reforms and the growth because I think that a lot has been priced in. The market is not cheap at all. And so with all the good news and the hopes being priced in, I think that over the next 12 months, India will have to deliver the growth and the reforms and the and in order to justify the current valuation. So I think that it is quite critical that the delivery has to be strong.
Khiem, what's your sense on the IMF cutting the global growth forecast and what it could mean for global markets?
I think that the IMF has been a bit slow actually to confirm this downgrade of economic growth. I think that if you read the broking analysts and economists, they have downgraded global growth as a result of what happened in the US in the first quarter and as a result of the slow China growth in the first quarter as well. So I think that a lot of that has already been factored in. And so that's why I don't think that investors care too much about the release of the IMF forecast a few days ago.
How come most of the money managers are ignoring geopolitical problems? For the moment, the way volatility is down and how stock markets are sitting at a multi-year high, it appears that no one's bothered about Iraq, Ukraine, Middle East, Russia.
Yes, I think that is a fair point. I think that basically perhaps investors believe that there will be some kind of a political compromise solution to that, and that the whole thing doesn't blow up. So yes, you're quite right. The glass at the moment, from an investor's viewpoint, is half full, definitely not half empty. And the reason why it is half full is because the equity markets over the last 12 months have had a very nice, strong positive momentum. So that positive momentum, I think that is dominating equity investors' sentiment right now.
So, Khiem, do you see equities outperforming bonds, and which global markets do you see outperforming? Because as of now, we are seeing somewhat of a secular rally play out, be it the US markets or, for that matter, some of the emerging markets like India.
Yes, I think that that's a fair question as well, because bond rates actually have surprised on the downside in terms of the lower yield year to date. I think that if you had asked investors at the beginning of this year where the US 10-year bond rate would be trading, definitely there will be very few people answering 2.47% in July of this year. So I think that definitely that has surprised on the downside, and most of the bond rates also have fallen. However, if you compare the total returns of equities against bonds, equities still outperform bonds. So I do think that with the economic recovery happening in the US, happening in China, and hopefully in India and the rest of the world over the next 6 to 12 months, I do think that equities should continue to outperform bonds.
Khiem, as we speak for the moment, the US 10-year paper is below 2.5%. if US economy recovers, interest rates would move up and yields are likely to move up. Do you think if US bond yields move up, that could have an impact on global liquidity?
I think that it depends on the extent of the rise. Yes, you're quite right in asking, a very good question, because if the 10-year bond rate in the US were to rise from the current level of 2.5% to above 3% over the next 3 to 6 months, I'm sure that will have some kind of an impact on the US equity market and maybe some other global equity markets as well. Unless earnings per share growth in the US is going to surprise massively on the upside, in which case you have a countervailing factor which can offset the rise of bond yields. But that requires EPS growth in the US to rise something like 12 to 15% per annum over the next 12 months. And currently, the EPS growth rate in the US is only about 7%. So you need to imagine a scenario where EPS in the US has to double the current growth rate in order to offset, a potential rise of bond yields to 3%, which I think is difficult to imagine. Therefore, the conclusion has to be that if US bond yield were to rise to above 3%, then I think that that will definitely have a negative impact on equity markets.
What about the dollar index? Would dollar continue to appreciate?
I think that once again it depends on which currency we're looking at when we compare the US dollar against. Because I think that when you look at Asian currencies, in fact, Asian currencies have, in general, have done reasonably well against the US dollar. It's stable to slightly higher year to date, whereas the euro, for instance, is under a bit more pressure. So I think that it really depends on which currency we look at.